Hello, my name is Jingonelli, and today we are going to be looking at IAS 8, which talks about accounting policies, changes in accounting estimates, and errors. Let me hope you're having a good day. So, with this, I'm going to require maximum attention from you. Make sure you're not distracted by anything, and you're having where to note. So, this standard is as of 2022. So, before I begin off, make sure you subscribe to the channel. It will bring you some good luck in your forthcoming exams. So with this standard, it addresses 4 topics. We're going to be looking at the, hope you're seeing, we're going to be looking at the selection of an accounting policy, change of an accounting policy, change of accounting estimate, then change of prior period, errors. So the general rule of the IAS 8, it prescribes the criteria for selecting and changing accounting policies together with the accounting treatment and disclosure of changes in accounting policies, changes in accounting estimates, and correction of error. So the whole standard is rotating around these 4 topics. So make sure you're fully listening in, you're not being distracted, and you understand what I've written down, because I've written this information down so that you can be able to cope up with what I'm saying, than me talking and you eventually get lost. So whatever I'm going to be talking, it's what I've written down to enable you to understand more. So having known that, looking at the term accounting policies. Now with accounting policies, the IAS 8 defines accounting policies as the specific principles, bases, conviction, rules, and practices applied by an entity in preparing and presenting financial statements. So when they use the word policies, obviously you'll get to know that there are many policies. So this suggests that entities are allowed to choose between alternative accounting treatments. So however, the entity's accounting policies will be dictated by international standards, which permit no choice of standards. So you're going to find standards that do not permit, do not give you any choice to choose a particular accounting policy. You just have to go by it. So for example, you're having the IS2 that talks about inventories. So inventory should be consistently measured at the lower of cost and net realizable value. So if I'm having an example, you're having 100k, and also you're having the NRV of 80k, then you're going to take the lower, because the standard says take the lower of cost and NRV. So you're going to be taking the 80k, as I've indicated here. You're going to be taking the 80k. So having known that, then we're having another one which talks about the provisions, which is IS 37, provisions, contingent liabilities, and contingent assets. Now for contingent liabilities, it is more to do with providing coverage for losses. More so, you can easily get this by maybe if I told you you've gone to court, and through court you're being given an asset, like somebody is to compensate you for something. And also sometimes it can work the other way around, when you have to compensate for someone. So those can be the contingent liabilities and contingent assets. But for this standard, what we need to pick out, as per now, it does not allow entities from recognizing these contingent liabilities and contingent assets. Only it says you only make disclosures to the notes. So for example, if there is a court case and money is to be given, it is not recorded as income. That is not allowed. We just have to make disclosures to the notes. So we're having another one which has IS 8, which talks about the intangible assets. So with this, it prevents entities. This one, it prevents let me use my cursor. It prevents entities from recognizing internally generated goodwill, that is inherent goodwill. So this inherent goodwill is never recorded. So that is with IS 8 intangible assets. But sometimes standards do permit a choice. For instance, we are having the IAS 16, property, plant and equipment. It allows a choice between the cost model and revaluation model. So that is with IAS 16. Similarly, we're having the IAS 38, which talks about intangible assets. Still, this allows intangible assets to be measured using either the cost model or the revaluation model. So now, looking at our first topic, remember I had told you the IAS 8 is going to be talking about 4 things which we listed above. Let me take you back just for a recap. Selection of an accounting policy, change of an accounting policy, change of an accounting estimate, and then correction of the prior period errors. So now, but now we are looking at the selection of an accounting policy. So with this, IAS 8 provides the following guidance on the selection of accounting policies. So if an international standard or IFRIC interpretation made specifically applies to one item, the accounting policy which is applied to that item should be determined by applying the relevant standard or interpretation. So hope you get enough time to absorb this statement and you analyze it very critically. So in absence of the international standard or interpretation that specifically applies to the item concerned. So if at all the international standard and the interpretation that specifically apply to that item are absent, management should choose or should use its judgment in selecting an accounting policy that prevents information which is relevant and reliable. And by reliable we mean provides a faithful representation. So with this, in making this judgment, you don't just make a judgment. So in making this judgment, management should refer to the guidance provided by the international standards and interpretations which deal with similar or related issues. Then another one, it should also refer to the definitions, recognition criteria, and measurement concepts for assets, liability, income, and expenses as provided for in the conceptual framework. So management may also consider most recent pronouncements of other standard setting bodies that use a similar conceptual framework to develop accounting standards. Other accounting literature and other accounting literature and accepted industrial practices, as long as they do not conflict with the international standards, the interpretation, that's the IFRIC interpretation of the conceptual framework. So you can see that if at all you're having if at all there's absence of the international standards or in the IFRIC interpretation that applies to an item concerned, the management can come in. They bring their own judgment, but this judgment must be based on the two, or it can also be considered. They can also consider from the recent pronouncements as I've explained below here. So moving on to what IAS 8 stresses. So IAS 8 stresses the need for consistent application of accounting policies. So having selected an accounting policy in relation to an item, that policy should be applied consistently to all similar items. So hope there I'm clear. So change, I'm trying to make you understand IAS 8 so that when we are dealing with the example, at least you'll be able to appreciate what we shall be doing. So change in accounting policies. IAS 8 allows an entity to change an accounting policy only if the change is required by a standard or interpretation. Another one, the results in the financial statements provide reliable and more relevant information. This is key. So the users of financial statements need to be able to compare an entity's financial statement from one period to another. And for most of the questions we are going to be doing, if I told you to make a change, if I told you to make a change in an accounting policy, you must make sure that the previous year, at least for the change in an accounting policy for the previous year, at least you will have to go backwards to check whether things are okay in the previous year, and then you move forward. So therefore, the same accounting policies should be used from one period to another unless the above conditions are satisfied, that is I and II. So accounting, now here we are going to another thing, accounting for the change in accounting policies. If a change in an accounting policy results from initial application of international standard or IFRIC interpretation, the change must be accounted for with the transitional provisions, if any. And for transitional provisions, they can mean they provide relief from certain requirements, or provide entities with additional time to comply with the requirements. So if I told there has been change, and this change resulting from the initial application of international standard or IFRIC interpretation, the change must be accounted for with the transitional provisions, if any, which are provided in that standard or interpretation. But however, if there are no transitional provisions, or if the change in the policy has been made voluntarily in order to improve the relevance of the financial statements, then what do we do? The IAS 8 requires that the change should be accounted for retrospectively. Retrospectively, from a layman's language, you can say maybe go backwards. Like you have to relate and go back to the previous year as if that change had occurred in that previous year. So what does retrospectively mean? This entails the following, or what do they fully mean by retrospectively? So with retrospectively, giving you that hint of the layman language and what it entails, there must be comparative figures for the previous period. So comparative figures for the previous period must be adjusted and presented as if the new accounting policy had been always applied. This is what I've been talking about. And then the opening balance of each affected component of equity, usually the retained earnings, must be adjusted, as we are going to see in our question today. So this adjustment usually takes place within the statement of changes in equity. So retrospective application maintains comparability between accounting periods, and this approach must be adopted unless it is impracticable to do so. So retrospective application, at least for it maintains the comparability. That's why even most of the times we go back to the previous year, so that we can have two periods, or periods that at least have some comparability. So if I told this is not possible or impracticable to do so, it may be because you don't have enough information. So then you could just go prospectively. Prospectively may mean, like, maybe in the layman's language, to move forward. You just have to continue. If I told you don't have enough information of the previous year, and you were maybe meant to go retrospectively, so for this it will mean that it is impracticable, so you just need to move forward. So we're having exceptions. An important exception to this requirement arises in the case of IAS 16, that is PPE, and IAS 38, that is intangible assets, where an entity changes from the cost model to the revaluation model. So in this case, the international standards require that the change is applied prospectively, not retrospectively. So if I told you adopt where they are changing from the cost to revaluation, you are not allowed to go back and use the cost model. You just have to apply revaluation constantly throughout. That's why they're saying you just have to to apply the change must be applied prospectively. So having known that, we can now, at this point, we are fit to handle our question with the knowledge from or from the background knowledge of the IAS 8. So a company began trading on 1st January 2017, preparing accounts to 31st December each year. As at 31st December 2019, the company adopted a new accounting policy with regard to the management of inventory. If the new accounting policy had been applied in the previous years, the company's inventory at 31st December 2017 would have been £150,000, higher than the original calculated one. So similarly, the inventory at 31st December 2018 would have been £400, higher than the amount originally calculated. So we're having an extract from the draft of the comprehensive income for the year 31st December 2019, meaning 2019 is going to be our current year. So this is before accounting for accounting respectively for the change in accounting policies. So this they are as follows. So these are the original figures. 2018, we're having profit before tax of this amount, tax of this amount, and the total of this amount. Then 2019, profit before tax of this amount, taxation of this amount, and profit after tax of this amount. So we're having some additional information here. The retained earnings were originally reported to be as this amount, which is £2,360,000 on 31st December 2018, and no dividends were paid in any year. So it may be assumed that the company's taxation expense is always equal to 20% of the profit before tax required. And they're saying rewrite the extract from the company statement of comprehensive income for the year 2019, showing restated comparative figures for 2018. So in other words, for this question, they want you to look at 2019 and 2018. But remember, in our question, we have been given some information of 2017. So meaning this information is going to affect something in 2018. Let's read B also. Prepare an extract from for the company statement of changes in equity for the year 31st December 2019, showing changes in the retained earnings. So we're having a solution here. Then I told you already our current year is going to be 2019. Previous year is going to be 2018. So for part A, which was requiring us to prepare a statement of comprehensive income. So but now, before we prepare all this, I want us to have a simple working, because after you mastering this, you will not need to do this, because you'll be in the exam. This is it will require you to do this at a fast rate, that is through the practice. So let me take you at a slow pace so that you can be able to draft out the correct info. So what you need to know when you're doing this, the changes in accounting policy or something to do with inventory. So inventory, we are having closing stock. So what happens when closing stock, by the way, you can note this somewhere. When closing stock increases, cost of sales will decrease, gross profit will also gross profit will rise, then the net profit will also increase, then the tax liability will also increase. Then what happens when opening stock increases? The cost of sales will increase, the net profit will decrease, the gross profit will decrease, the net profit will decrease, and also the tax liability will decrease. So proving this, because don't just cram this, at least after you understanding it, you can now put it in the head and you know that this happens, this happens, this happens. So let me prove one. I'm going to prove this first one. Imagine gross profit is equal, no, not imagine, this is the formula. Gross profit is equal to sales minus cost of sales. So cost of sales, remember, is equal to opening stock plus net purchases minus closing stock. So assuming, now here you can imagine, assuming cost of sales is equal to this is the formula, plus purchases minus cost of minus closing stock. We imagine initially we are having 100, cost of sales equal to 100. Now the combination of opening stock plus purchases comprising of 150 minus the 50. So with this, now imagine if I told the cost of sales increases by 10. Now from 50 it goes to 60 as I've showed here. The rest become constant. The opening plus the purchases become constant. So 150 minus 60, you're going to realize that the 100 now is going to decrease to 90. So this is what I was talking about, that if there is an increase in cost of sales, or if there is a decrease in the closing stock, your cost of sales is going to decrease, and I've proved it. So meaning that cost of sales is 90 now. So when costs reduce, now from this point again, remember when cost of sales when it reduces, just applying general knowledge, when as costs reduce, obviously you're going to realize high profits. So when the costs reduce, your net profit is going to automatically increase, and thus I've proved this. So when closing stock increases, cost of sales is going to decrease, and when cost of sales decreases, obviously the profits are going to go up. That is gross profit, net profit. And when the net profit goes up, obviously they're going to tax you highly, so the tax liability is also going to increase. So similarly with proving 2, assuming cost of sales is 100 and opening stock plus the purchases is 150, assuming that opening stock is maybe 100, purchases is 50 minus the closing stock, and maybe your figure for opening stock goes up. So when it goes up, you'll be having 160. This 150 changes to 160, then this one is constant minus 50, and then you realize you'll be having now 110. So from 100 to 110, meaning that if at all your opening stock increases, cost of sales is going to increase. And applying general knowledge, once your costs go up, your profits have got to decrease. So this is what happens: gross profit decreases, net profit decreases, and even the tax liability. Once your profits are low, they're not going to tax you highly. They're going to tax you at a lesser price or at a lesser amount. So in conclusion, when the costs increase, the net profits reduces. So having known that, when we go back to our question, now I'm going to show you what this means. Where we're going to be applying this. We are going to be applying this. So when we go back to the question was saying somewhere that the balance in 2017 was 150,000 pounds. So here, remember when the closing stock let me take you back to the question. It's here. The company's inventory at 31st December 2017 would have been 150 pounds higher. So meaning that the closing stock in 2017 would be 150 higher. Where is it? Okay, it's here, right here. So when closing stock from 2017 increases by 150 pounds, it will mean the increase will come to 2018. So the company opening stock for 2018 will increase by 150, reducing profits before tax. Remember, profit before tax is going to be like our net profit. So it reduced the profit before tax by 150. What do I mean? When I'm to look at one here, remember amounts came from 2017, they came to 2018. So meaning that Now our opening stock in 2018 is going to increase by how much? 150,000 pounds. So once opening stock increases, obviously the net profit, or the net profit which is here, that is the gross profit stroke the profit before, no, it's going to be gross profit because it's not yet subjected to a tax or something like that. So the gross profit is going to decrease. So once the gross profit decreases, we are going to just come and indicate, we are going to just come and show that the opening stock from 2017 would be 150 pounds higher. So you just come on the original figure of profit before tax and you subtract it with the original figure. So as you can see here, I subtracted. So that meaning that from this point of view, meaning that if opening stock increases, it will reduce the net, the profits before tax, which can be struck with the gross profit. So that is what happens. So opening stock increases, it's going to reduce the gross profit or the profit before tax. So, and then we are also having another point in the question. They had said, similarly, the inventory at 31st December 2018 would have been £400 higher than the amount originally calculated. So here what is happening? You find out that the closing stock, when you look at this, the closing stock in 2018 is increasing. And so once the closing stock in 2018 is increasing, meaning our gross profit is also going to what? To increase. So you just have to come to the profit before tax. We're just going to come to the profits before tax of 2018, and we added that our 400,000 pounds. So meaning our closing stock of 2018 is going to increase by 400 pounds, meaning that if at all the closing stock increases, what's going to happen? Our gross profit is going to also increase. So we're just going to come and we add. So this is what we do, we add. So meaning our restated profit before tax figure is going to be 1,900 minus 150 plus 400, which is going to give us 2,150. So remember our tax from the question, they were saying tax is being subjected to 20% of profit before tax, which is this, giving us 430. So having known that, we can easily now get the difference between this, and then we get our profit after tax. So having known that working, when I come to the working of the profit before tax for 2019, it's going to be, remember, our closing stock in 2018 was 400 higher. So when we come to 2019, remember our opening stock is going to increase, and as our opening stock increases, it's going to also increase our cost of sales. Once the cost of sales increase, then our GP is going to also reduce, which is like the profit before tax. So when we come to our figure here in 2019, we're just going to reduce it by 400. So this is coming from the closing stock of 2018, which is going to be our opening stock in 2019. So it is having an increase of 400 higher. So this 2,600 minus 400, you're going to get a restated figure of 2,200, and our tax is going to be 20% of the profit before tax, which is going to give us 440. So when we are to now when you're in the exam, this is what you're going to be doing. You're going to give it a title, Statement of Comprehensive Income for the year December 2019. After accounting this is after accounting respectively for the change in accounting policies. So the following, this what we have been doing here, it's just a working which you can put somewhere, maybe at the back of the paper, once you want to find out the figures that are going to be restated, or somewhere you show working when you're going to give the statement of comprehensive income, having those adjustments, you're just going to come 2018, 2019, you bring the new figures. So profit before tax, what we had calculated above was this, our tax was this, and for 2019 was this, and our tax was this. So this minus this, you get 1720. This minus this, you get 1760. So from the interpretation, because you could say that such decisions were material in nature, I mean such figures could bring in that element of materiality, whereby the certain change in these financial statements could influence the decisions of the users of such financial statements. So the figures indicated in the financial statements for 2018 to 2019 show an increase in profit between 2018 and 2019. So this was after the adjustments. So after the adjustments, you can see that with these new figures, if you're using new minus old divided by old times 100, this new one, which is 1760 minus the 1720 minus the old one, which is 1720 times 100, it gives you 20%, and you would you would see that the it shows that the profit between 2019 and 2019 is of an approximate of 2%, sorry. So meaning, whereas the original figures were distorted by the change in accounting policy, suggested incorrect profits had raised nearly to 37%, which was wrong. So when you look at the previous old figures, from the question, this is going to be our new, this is going to be our old, this is going to be our old. So when you come and place them accordingly, you're going to see this is 2018, this was the figure, this is 2019, this is the figure, this is of 2018, this is the figure divided by the figure of 2018 times 100, which gives you that 7%. So when we are to go to part B, part B was requiring us to prepare an extract from the an extract from the company's statement of changes in equity for the year 31st December 2019, showing changes in the retained earnings. So we are supposed to show the changes in retained earnings. So with this change in retained earnings, what we are going to do, remember, retained earnings are undistributed profits. So now I'm going to first begin with the theory, and then I practically show it to you. Remember, in 2017, the profit before tax would have been 150,000 higher if the new accounting policy had been always applied. Now we are looking at 2017 because 2017 is going to affect our figures in 2018, because by default we are supposed to look at 2019 and 2018. We are not concerned with 2017, but since the question gave us a hint on gave us information in fact of 2017, meaning 2017 information is going to affect our 2018 figures. So we need to also adjust, get to know what happened in 2017, so that we can bring it to 2018 and adjust accordingly. So meaning this figure in the profit before tax had increased by 150 higher if this change had always been applied. So meaning that the tax liability would have been increased by 30%. Where does the 30, would have been increased by 30,000? Where does this 30,000 come from? The 30,000 comes from the 20% of this higher figure in the profit before tax. Remember, they were to subject a tax 20% of the profit before tax. So this 150, which was embedded within that original figure, is what we get, the 20% of 150, and so resulting to this amount. So when you get 20% of 150,000, you're going to get 30,000, and so the profit after tax would have been 120,000, which would have been the difference between 150,000 minus the 30,000, giving you 20,000. So meaning that the profit after tax would have been 120,000 higher, and that's how you get it, the difference. So in total, therefore, the retained earnings at 31st December 2018 would have been 320,000 higher. How does this figure come about? It comes about from the once you get this 120,000, you add it on to the difference. You add it onto the difference which you would get from the new and the old profit after tax in 2018. So let me show you how you get the 200 here. The 200 is going to be got from, remember, these are the new figures in 2018, the adjusted figures. You remember we came from old figures of 2018, which were 1,520. So 1,520, if we are to remove it or subtract 1,000, so with this figure, if you are to get the new one, which is 1,720 minus the 1,520, you're going to realize that now you'll be getting the 200. That is what I mean, the difference between the new and the old PAT in 2018. So when you add this plus this is coming from the PAT of 2017. So you would get the 320,000 if the new accounting policy had been always applied. So meaning that will be the figure for retaining earnings combined in 2018. So now practically this is what I was meaning. The profit before tax in 2017 was 150,000 higher, and the tax is 150,000 times the 20%, giving you 30,000. So the difference between this and this giving you a PAT of 120,000. So 2018 was having an original figure of PAT of 1,520, and the restated figure in still in 2018, which led us to 1,720. When you have to subtract these two, the difference between the new and the old, you're going to get 200. So this 200 is what you are going to add. So the extract from the change in equity for the year 31st December is as follows. Retained earnings. So we're under we're handling the change in equity, statement of changes in equity, and we are looking at the column for retained earnings. In the question, we are having balance brought forward of 2,000. Remember, I'm using it was, in fact, okay, it was 2,360,000 pounds, which I've showed here from the question. Let me take you back where additional information was starting from. Here, retained earnings were originally reported to be this amount as on 31st December, and no dividends were being paid. So once you do that, once you indicate this figure here, the balance brought forward from 2018, then the change in accounting policy resulted into these figures here. So meaning that you were having 2,000 from 2018, and this 120 came from 2017. I showed you how this came about. So once you add this, you're going to get 320. So this plus this, you'll get a new restated figure of 2,680. So for the profit for the year 2019, because profit for the year 2019, this is our current year, is going to be, now you go back to our new figure, which is this. Our new figure was this, the restated figure. So this is the profit for the year, which you're going to come and drop here. Profit for the year. So once you add this restated one plus the profit for the year, you're going to get a balance carried down of 4,440. So this is going to be our balance carried down for the retained earnings. So just for the That will be it. That will be it. But we can add on something just to help you understand more. If the change in accounting policy had not been accounted for retrospectively, the retained earnings figure would still have been 4,440,000 pounds, and this is got by. So for you to prove this answer, you can even just get the opening balance of 2019, which was, this is to do with the opening balance of 2019, which was in the question, the 2,360,000 plus the PAT of the original figure, that is of 2019. Where is it? It's here, 2019. This is the original figure, and then you come and add it with this opening balance of 2019, and then opening balance of 2019, that is of the retained earnings, plus this PAT of the original figure. You're going to realize that you will get this, so that will mean that whatever you have done is correct. But this is just to help you, like, maybe prove your answer here whether it's correct. So however, if you just add this, and this, and you get the retained earnings, it will mean the distribution of the earnings for the 3 years concerned would have been different and misleading. So that's why we do not just add them like this, and we get a straight figure, which is this. We must show whatever we have worked out for previously to land to this figure. But for this figure, this is just a way of proving it that you're doing the correct thing. So with that, thank you so much for watching. Make sure you subscribe to the channel.